And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Ernest Zach, who's the CFP at Main Street Financial Solutions with over $3 billion in AUM. Ernie, thank you so much for taking the time and welcome to the Smart Money Circle.
Wow, Adam, thank you so much for having me. It is quite an honor. You and I have spoken a lot over the past few months, and I'm honored to be here. I'm gracious that you asked me to do this. I don't think my story is compelling at all, but apparently you do, so I'm certainly happy to share it.
Those are usually the best ones. All right, Ernie, I know well, my first question is, I know you come from humble beginnings like me. Please let us know your story and how you got to where you are today.
Sure, happy to share. So I grew up in the Bronx just like you did. Um, and modest beginnings. My father worked in the Hunts Point section of the South Bronx. My mom was a stay-at-home mom, and took us to the zoos and museums and things like that. And yeah, it was quite simple. There was no people with money in the Bronx, so I didn't have rich friends or family that I could ultimately call on later, which is relevant to having built this business. There was no pool of people that you can actually call on. So I certainly have a great appreciation for people that have actually, built a business from the ground up just through, passion, and then of course a lot of sweat and hard work. I caught my break on Wall Street in 1995. I started as a phone clerk for a small boutique firm based in Baltimore called Alex Brown and Sons. And it was in November 1995 that I started. And that day, the Dow Jones Industrial Average broke 5,000 for the first time.
Wow.
And I remember back then, it was all new to me. The Dow, the S&P 500, I knew of them. I studied economics in college. But just to be down there was just quite an experience. And but even then, the talking heads in the media were saying that the market was overvalued. And I think that's relevant. And I bring that experience to my practice because there's always going to be somebody in the media, bulls and bears, that are going to say the market is overvalued, the market is undervalued. And it kind of leads us to a path as individual investors to make rash decisions based on the last news report or the last person that they heard in the media. So rewind that. I spent about, I guess, 10 to 15 years uh, surviving various mergers on the New York Stock Exchange floor, right? Alex Brown was taken over by Bankers Trust and then promptly Deutsche Bank. And then I went to a smaller boutique firm called Schroders. Citigroup bought them. I was part of them. Smith Barney, Citigroup. And towards the end of my career, as the market's fragmented from eighths to sixteenths to pennies, so a penny spreads, dark pools of liquidity started to come into play, and a lot of electronic trading was happening. So the floor of the New York Stock Exchange, as we knew it from, say, the movie Wall Street with Michael Douglas, that's gone. If you watch it now, it's really more of there's some active trading going on, but most of it is done through this electronic trading platform. And I was working for an individual towards the end of my career on Wall Street by the name of Peter Kenny. He had a lot of really good buy side relationships, and buy side are the ones that really control the order flow, right? The portfolio managers, say from Vanguard, American Funds, Fidelity. And I was his trader for his relationships, and I was utilizing the dark pools of liquidity. And so just kind of take a step back from that. Prior to that, when the open outcry system on the New York Stock Exchange was in effect and you were trading in eighth spreads, which is 12 and a half cents, if an institution, say Fidelity, wanted to buy XYZ stock, there was no anonymity. They would go down to they would call the clerk, which would be me, give it to the floor broker, and then go out to the specialist post and say, Fidelity Asset Management wants to buy XYZ stock. And that news would spread all across Wall Street, all the money managers, right? And so the stock would run up on price artificially. It was a highly inefficient way, to be honest with you, of matching buyers and sellers. So the whole industry morphed. They went from eighths, like I said, to 16th spreads and then a penny spreads. But then the institutional money managers, they could hide their large positions they wanted to get into or out of without adversely affecting the market. right? So you go to an algorithm and you bid for 100 shares. You don't know if they want to buy 10 million shares or 2,000 shares, right? So it's done so much better for the individual investor in terms of price, in terms of keeping commissions much, much lower. Because in addition to the 12 and a half point spread, you had about 3 or 4 cents commission per share as well. So it was it was just not good for the individual investor. I learned to understand supply and demand as it relates to stock price, right? So it was good for the individual investor, but what ultimately happened was the entire stock exchange floor, we got wiped out.
Got it.
So everybody had to go on and get new jobs, and it was daunting because the change was coming gradually. We all saw the iceberg coming, but you just couldn't jump off the ship because we all had responsibilities, we had families, and the paychecks were good. So when the end did finally come, for me it was I guess it was like January 2009, and I wanted to stay in the business. So I nobody was hiring except for Edward Jones, right? And I wanted to become a personal financial advisor. So I joined them in January, like I said, 2009, or maybe February, March of 2009. And they were just a great firm to teach me how to network, teach me how to get plugged in. It was a wonderful training program. They flew us out to their headquarters in St. Louis. When I say us, I mean the graduating class that they had hired. Um, and I believe it was about, my class was about 100 people. And the first day they said, look to your left and look to your right. Most of you will be gone. You will not survive this. And a lot of it is just through attrition. People just don't like the job because it is difficult. It's sales, right? For all intents and purposes, as a salesperson, you hear no all the time. And that could become very frustrating after a while. And they said about only 2 or 3% of you are going to survive. And as luck would have it, out of that class of 100, me and the roommate they paired me up with.
Wow.
I'm not going to drop names, but he is a great guy. He's down in Baltimore. And so there's a lot of sense of pride of having survived that. But I owe a lot of gratitude to them. It's a great firm. It's a small boutique for mid-sized investors. But after about 3 years with them, I got a call laterally from a recruiter at Merrill Lynch. And I just felt for me at that time, I was living in Westchester County, New York. I joined Merrill Lynch in the White Plains, New York office. And my AUM was still relatively small, having only spent a couple of years with Edward Jones. So I had to survive the Edward Jones training program, which I did. And then I had to go through the Merrill Lynch training program. And they too had excellent training. They just teach you not only how to network, how to get plugged in, but all the myriad of investment vehicles that are out there. I mean, it can really be overwhelming, even to the most seasoned advisor. So I spent about 10 years with Merrill Lynch. And in that process, I had obtained my CFP designation. And if anybody does hire a financial advisor, you really want to look for that CFP, the Certified Financial Planner. We are fiduciaries, and it's a word that's thrown out now a lot, especially with a lot of investment commercials. But there is a legal term for the fiduciary, and without going down that rabbit hole, it's basically you have to do what's right for the client. Sounds a little redundant, right? If we're, client focused, don't we always have to do what's right by the client? But there are different legal parameters, especially between being a fiduciary and what's called the best interest. So one can argue you made a decision that's in the best interest of the client, but it wasn't a fiduciary type of a situation. So we can delve into that later if you want. But so I got my CFP designation, and person that I hired, his name was Brett Danko. Well, his name is Brett Danko. He was really known in the financial community as having a wonderful training program, and he would graduate or get people upwards of 50% to pass the CFP the first time through. So I signed up for his class. I was down in Mount Holly, New Jersey. I'm living in Westchester, and my book AUM was still small, so I would drive from Dobbs Ferry, New York to Southern Jersey every day for each of this, I think, 7 or 8 legs of the CFP because we couldn't afford a hotel, right?
Right.
So we did that. And the first day, Brett walks into class and he's wearing sweats and a t-shirt. Now, I don't have an ego, but I'm thinking to myself, this guy is going to teach me the CFP, and I'm wearing my suit and my tie. And within 5 minutes of the class, he had me. He made storytelling fun. He made learning the CFP material easy to digest. And so fast forward, I passed the CFP exam the first time through, and Brett and I stayed in touch with each other. And if I had a question about a client or a situation, I would call him, right? I wouldn't call anybody at my current place, not for any other reason other than, Brett just had a way of simplifying things. I say this because when COVID happens, right now we're all locked down, we're all working from home. My wife and I, we moved from New York to North Carolina, and Brett was like, why don't you just join me? And I was afraid. I was afraid of leaving my book. It's a big firm, but I knew that in my heart, I wanted to be with somebody like that. So Brett owns Main Street Financial Solutions. So in 2001, my wife and I decided to leave the wirehouse that I was at and join Brett. So that was in 2001. I've been here ever since. I could not be happier. I feel that my experience between humble beginnings, working on the New York Stock Exchange floor, having survived so many different market events. For example, 9/11, right? I was downtown on 9/11 when the planes hit, and I literally watched people jump that day, right?
Oh,
And it was a
wow.
Tuesday. Markets were closed the rest of the week. They reopened on Monday to obviously a massive sell-off. So the markets, spoiler alert, they rebounded. And I've seen so many market sell-offs, right? Obviously 9/11, COVID, contagion, irrational exuberance, dot-com, telecom. I know I double named a few here. Putin going into Ukraine, tariffs now currently. But I feel like that experience has made me a better advisor because I can take the emotions, or at least I can try to take the emotions out for clients who look at the particular. This is a great day to be talking, actually. Again, well, great time because those that are politically biased one way or the other, they are emotionally involved with their decision making.
Right.
And what I try and tell clients, especially on the onboarding process, is that these market sell-offs all have.
I'm not sure what happened there, Ernie. We just glitched for a second, but please pick up where you said the markets all have one thing in common.
Sure. Okay. So the markets, what I meant to say was they have basically three things in common, right? It's all for a different reason, right? COVID, 9/11, right? Tariffs right now. They feel like they are going to last forever. There is nothing worse than watching the market go down for weeks or months at a time. And then the third thing that I tell my clients is that they always do come to an end. Um, I incorporate that. So my experience of seeing these market declines and the subsequent bull markets that follow is really important to me. Again, I go back to my story of humble beginnings and trying to appreciate and understand how just not just how money is made and earned, like what do people do for a living, but how is wealth created generationally, right? And so that's my story is trying to get my clients to understand not only the equity markets to an extent, because they have their lives, it's not their chosen career, but to also understand that, time in the market instead of timing the market and having the markets work for you in addition to what you're doing for yourself and for your family, right? If you're working, if the spouse is working, the market is the third leg in this equation that is going to help you create wealth. So I always go back to my story with my clients, my experience, um, different market cycles, hard work, all of that, and the sacrifices that I've made along the way.
Right.
Now, when I left Merrill to join Brett here at Main Street Financial Solutions, I was faced with a decision with another big wirehouse where they were going to give me a sign-on check, right? And with that would come about a 10-year guaranteed contract where I would have to work for them. And that bonus that they would give me would be prorated over 10 years and taxed as what's called phantom income. My wife and I talked about this religiously. We're like, we want to leave this kind of money behind. And ultimately we felt, my wife and I felt that it was in our best interest to just be to not have a contract, right? I don't want to have to work for a firm if I don't like them. And that's another story that I bring in. I don't I and my clients own money. We own money, but for a lot of people, it owns them. And I'm not talking material people that have to have the nicest car or a watch collection, right? I'm not talking material people that allow themselves to have money own them, but people who have worked hard and they have a nice little nest egg where they could live comfortably in retirement. The fear of the market owns them. I don't know if that concept is coming across here because sometimes people just think, oh, if somebody's focused on money, then they're very materialistic. There is a fear of money. There's a fear of losing money. There's a fear of running out of money before you die, right? And my experience of again having grown up the way I did and having turned down large sums of money for a degree of freedom, that's my story. And I'm very passionate about it. I feel very strongly that we should not be overwhelmed when it comes to money decisions. We should not be overwhelmed when the markets sell off, right? Because the strategy on the in as we go into the investment universe is asset allocation, not market timing. So I don't know if you have more questions on that. I love talking about this. I don't like talking about myself that much.
Yeah, no, you're doing a great job. So thank you for the story. It's a great story from humble beginnings. Just as a note to clarify, I grew up in Jersey, not in the Bronx, but my mother was a teacher in the Bronx. So I just want to
That's
clarify
okay.
that for the audience.
That's okay.
Outside of that, you have a great story. I love what you do. I love your purpose. I love how you help people overcome that control of money, where you said you control your money, opposed to most people have the money control them, where they lose sleep at night or they're not able to make decisions. They're paralyzed by the fear. So I think these are really, really great points that you bring up. But let's talk about the actual investment strategy that you use. Tell us about what you do at your business and anywhere else you want to go with respect to the onboarding a client. Client comes to you, then what? What do you do after that?
Okay, so that's a great question. It's a difficult question. Um, Understanding a client's risk tolerances, goals are the most important thing as well. That's very difficult to um, um,
Quantify?
quantify. Thank you.
Okay, you're welcome.
Because if you onboard a client during a bull market, they're going to have a much higher threshold for pain than they think they do. Likewise, if the market sells off, suddenly their risk tolerance is not what they said it was in the beginning. The onboarding stage of a client is very important, not because you want to hold them to it when the market sell off. Like, well, you said you had a high tolerance of risk. It's to remind them later that we had talked about this, but also to rebalance their portfolio. So my investment strategy is predominantly S&P 500, right? Large cap growth, large cap value. It's called core satellite. And that's not my term. That's a term that's out there. So you have your core equity portfolio, which is going to be the large cap growth, large cap value. And if it's 60-40, 70-30, for those who don't know what that means, the first number is the equity concentration in a portfolio, and the second number is your fixed income. So 60-40 is 60% stock, 40% fixed income. And fixed income could be treasuries, money market, right? Bonds, all of that. Now, so the core is going to be the equity component. Say it's S&P 500. Now, if somebody uses the benchmark of the S&P 500 to gauge a financial advisor's performance, well, the 60% S&P 500 is going to keep pace with the S&P 500, but the 40% is going to be a laggard, especially on the upside. On the downside, it's great, right? S&P is down 40%. You're only 60% allocated in S&P. You're outperforming the market on the downside, and it's an easier conversation. But as markets are taking off, the psychology of investing is, well, the S&P is up 20, I'm up 15. I want to be up 20, 21, 22. Suddenly, it's that full sense of risk tolerance that a person has when the markets are taking off. So the satellite component now is alpha generators. How do we potentially outperform the S&P 500 with a 60% allocation? And that's where you look at different asset classes. For example, small cap, right? Mid cap, international, emerging markets, high risk, higher reward. And one thing that I'm doing for just a handful of clients is we're buying call options in tech names. Now, to be clear, this strategy is simply market timing. The only advantage that I bring to the table with this strategy is that I'm sitting in front of my computer, I have my TV on all day, and I have the ability to jump in or out with what my client wants. So you have to lock in a gain and a loss for a stop loss, right? So you want to do a 10%, 20% gain, which is not difficult to do in a volatile tech environment. You can get 10, 20% in 1 or 2 days. Likewise on the downside, and especially February through April, you're losing more than 10 or 20%. But it's that idea of satellite. You have your core investment strategy. And again, my style is to be predominantly large cap growth, large cap value in domestic companies. Because a lot of these S&P 500 names are getting a lot of their revenue from overseas anyway. Some advisors they'll buy international, they'll buy emerging markets, they will buy small cap, they will buy mid cap, they will buy S&P 500, they will buy discretionary, they'll focus on energy. They'll hit all of the GICS, the global industry classification system. And when you do a portfolio review with a client, one of these asset classes are going to be up in the previous quarter.
Right.
So I'm not knocking that style.
Understood. I just want to clarify.
Yeah.
Sorry, Ernie, let me jump in for a second. What you do specifically. So you have the core strategy, long growth, long value, US stocks, and then you also have a satellite component on top of that, which could be generating income from call options or from other strategies that you employ. That's more or less the way you play the game. Is that
Correct.
okay?
Correct.
Wonderful. All right, next question for you. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
So that's another great question. So we kind of segue from the onboarding process with the client. Risk management and seeing mistakes that people make, 90% of the mistakes they make are them trying to either time the market, thinking that they somehow know better than the market itself, especially in downturn, or if someone is touting a hot stock, like Nvidia went from $1 to 1,000 before it split 10 for 1. It's this the emotionality that people have in thinking that they're either missing out on a roaring stock or they are going to die broke because of some policy that's going on or some world event that is going on. So it's the psychology of investing, with people just making bad knee-jerk decisions based on a feeling. The market doesn't care what you think. It doesn't care what I think. It doesn't care what Warren Buffett thinks. It simply is it has a mind of its own. I find it to be irrational in the short term. Like, for example, Palantir earnings came out, what's today, Thursday? They came out Tuesday after the bell, and they were good earnings, but it was down at one point, I think 16 points yesterday. How do you make sense out of that, right? So the market is highly irrational in the short term. People's mistakes are consistently made by them getting in their own way with their mental process. And I'm not faulting them for it because fear is a motivator. Fear of missing out, fear of losing everything, but it's still motivating them. If I could reel that in, and if any advisor can reel that in with 100% of their clients, we would all be better off.
Got it. That makes perfect sense. So you're saying make rational, not emotional decisions, and then pay attention to the fear and the emotions that drive you. Is that a good way of summarizing it?
Yeah.
Okay, wonderful. So next question for you, Ernie. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Now, in the investment universe?
Anywhere you want to go. Life, relationships,
Yeah. You really need to have somebody in your life that you can talk to. right? So I have made a commitment to be really good at investment advice. I want to be that resource for my client, and any good advisor wants to be that person. So I have made some, like all of us, some bad life decisions. We've made mistakes. Maybe picked the wrong major in school, maybe had a really poor diet early on in our lives, or was it a picked a bad relationship, and we all pay the price for that. So we've all made bad decisions, and inevitably they lead to financial hardship, right? So poor health decisions, now you have doctor bills. You're in a bad relationship, you have spousal support, or somebody ran up your bills, right? So on the macro scale, you have to have some type of mentor, someone to talk to. And I hope, or I set my life goal, my professional career goal, to be that person that can eliminate people making financial mistakes. So in your personal life, I can't help you with relationship advice. I can't help you with diet advice, right? Can't help you with your golf game. But get somebody that you can talk to instead of thinking I can shoulder this myself. I'm going to muscle through this myself. I'm going to fix whatever it is, right? If I have to lose 10 pounds, I don't need a weight loss coach. I don't need a gym coach. If I want to buy a house, I'm going to save the money myself. Get an advisor, get a coach, get someone that you can talk to. So I think that's the most important thing. I've always been headstrong. I've tried to always do things myself, and like everybody else, like you, like everybody watching this podcast, is they've made mistakes. And to me, that's the most important thing. If there's a person in your life or persons in your life that you can go to for advice, do it.
I love it. That's a really, really, really great way of compartmentalizing too. You're saying find the guy who can give you financial advice, find the guy who gives you fitness advice. Don't mix them.
Yeah.
Yeah, love that. Okay. What about timeless mistakes, either you've made or you've seen other people make, and how do you learn from them or avoid them?
So mistakes, again, that's a really big question. We've all made them. Some mistakes are more costly than others. Um, in the financial universe, buy quality, hold it. Don't try to time the market. Don't think you're smarter than the market. Don't have this fear of missing out. Don't let fear motivate you. And in the personal life as well, I mean, it's very difficult to quantify how to avoid making mistakes. I think recognizing when a mistake has been made, right? And the minute you recognize that you've made a mistake, right? My diet is poor. I'm in a bad relationship. Um, I'm not maintaining my house properly. I'm not cleaning enough. But the minute you identify that the mistake has been made, that's when one needs to act. And there's an old saying in this business, was people say to me, well, I wish I bought Nvidia at $1, right? I wish I bought Apple when nobody heard of Apple before, right? The time to invest is not only when you have the money, but it's when you're ready, right? I can't tell you how many clients I've onboarded and they were just skittish about going in. And when they ultimately do go in, they're like, man, the market, the S&P just soared 10% in the last 6 months. I wish I did it. That regret is really bad, right? Because when you're ready to invest, that's when you invest. Don't start having second guessing. If I had only gone to the doctor earlier, right? If I had only lost 10 pounds 2 years ago, if I only started picking up golf 4 years ago, I'd be better. It's that regret of living in the past. I do it. I'm sure you do it, Adam. It's
Yeah.
human nature. But stand proud when you're ready to make that a decision, and whatever it is. When it's if it's finance, if you're in a bad mutual fund, get out. If you picked a stock that you thought was going to be the next 10 bagger and it's not, sell it. Realize your 10, 15, 20% loss or whatever. And it's not having that regret. It's acting and being comfortable with the point in time in your life that you've made that decision. You can do that. If I could do that, if we could all do that, I could do it in the investment universe. But again, you avoid a lot of mistakes that way.
Yeah, I think that's a really great point. It's don't live in the past of, oh, I coulda, woulda, shoulda, I should have done this yesterday. Then you're missing the opportunity today. And all that energy on the coulda, woulda, shoulda doesn't even matter because that's never gonna go. You can't go backwards. You can't go yesterday and say, oh, I could have bought Nvidia at a dollar or Apple at a dollar or whatever the case may be. So I love what you just said there. Okay, final question for you today, Ernie. What is the best piece of advice you'd like to give the audience or your 30-year-old self?
Well, 30-year-old self, I've made a lot of mistakes. I would say probably uh, uh, I think my 25-year-old self, I would say don't rush into marriage. Okay. So I have made that mistake. I kind of rushed in for no reason, and it wound up being an emotional and financial hardship for a long time after that. But I have a wonderful wife now, and together we have made some difficult decisions, career choices, and I feel like for the most part, they've been good, right? So get that good person in your life, whether it's a spouse, whether it's a friend, if it's a parent, if it's a mentor, if it's an old teacher. I mean, I'm still talking to my accounting teacher from 1985 in JFK High School in the Bronx. We're still dear friends. He's a mentor of mine. I go to him for advice. That's what I would say. Do not go through this life alone. It is so difficult. We all, whether you come from money or not, right? And having worked on the stock exchange, I worked with a lot of kids of affluent parents. They had difficult decisions to make too, right? There's a lot of pressure to not just match what your parents have been doing, but to exceed, to make more money than your parents, to be in a happier relationship. So whether you come from modest beginnings, humble beginnings, or completely affluent, people have difficult decisions to make, and they all make mistakes. So you want to just get a multitude of people in your life to make you feel good about yourself, to make you not let you dwell on the mistakes that you think you've made as a person. So that would be my advice. And again, I'm folding it back to finances. I want to be that financial resource to my client. I want to be the one that keeps them from making that one big financial mistake. And
Got
if
it.
I can do that, I've earned my fee, right? And a good financial advisor will charge between a 1% of the assets under management to 1.5. A good financial advisor is worth 10%. Like, so for example, don't pay your advisor 10% if he's offering 10%. It's too much money. But what I'm saying is this: look at the first quarter of 2020, the COVID sell-off. The S&P 500 in the first quarter was down about 20%. I think it was like 18.2, right? But let's say 20%. For the rest of the year, right, from May to December, it wound up gaining about 20%, right? So you would think that's a 40% gain, but it's actually more than that, right? So simple math. You've got $1 million in your portfolio, you lose 50%, you're at 500,000. You need 100% gain to get to that $1 million mark. So now rewind back to the COVID sell-off. A lot of people panicked because this sell-off is the only one that really scared me because we didn't know when was it going to end. People were dying every day. The streets were desolate. It was just a very dark time. The market was selling. I'm trying to tell my clients to stay invested, and the market completely turned around. A good advisor kept their clients invested, right? How many people sold in April? I'm sorry, in March, right? January, February, March, the end of the first quarter, as the markets were continuing to plummet, and then they never got back in. So you're locking in a 20% loss for that year, and then you miss the subsequent 40+% rally. An advisor is worth their weight in salt, whatever you're paying them, to keep you from making that one financial mistake. And if that means just keeping them invested, especially now during this February, March, April with the tariff situation, it's going to work itself out. It always does. So get advice, have somebody that you can trust, that you can talk to, get solid advice from. And then if it is good advice, you got to follow it, right?
I
What good
love
is
it.
good advice if you don't act on it?
I love it. All right, Ernie, thank you so much for taking the time today. I'll have a link to your website in the description, and hopefully we'll have you on again soon. This was great.
Adam, I had so much fun. Thank you very much.